Welcome to this explainer. Let's just dive right into the urgent realities of tax loss harvesting. Section 1. The vanishing tax deduction. Let's look at this really common trap. So you think you're pretty smart harvesting those stock and crypto losses to lower your tax bill, right? We all do it. You sell an asset that's down, take the loss on paper to offset your gains, and you feel like a pretty savvy investor. But here's the catch. In the 2026 financial landscape, one wrong move makes that precious deduction vanish instantly from your return. Literally poof, it's gone. Which brings us to Section 2, the wash sale minefield and its incredibly strict reporting rules. To really understand why this is happening right now, we need to look at some insights from CPA Brian over at Hidden Tax. He points out a staggering figure, $39 trillion. That's a lot of zeros. With a national debt hanging overhead that is that massive, the government is actively hunting for revenue absolutely everywhere. This is the fundamental reason behind the tightening of tax rules that are directly impacting your personal portfolio. Brian actually describes this environment as a literal minefield. He warns, and I quote, "The IRS loves it when you trip over this invisible wire. They use strict reporting rules to siphon away your legitimate investment losses." That is a stark warning. It basically means we need to skip the economic theater and focus on the cold, hard reality of how the IRS operates to eliminate those tax savings. Okay, so what's the actual legal mechanism behind this trap? It's Section 1091 of the tax code, much more commonly known as the wash sale rule. This rule explicitly states that if you sell a security at a loss, but you turn around and buy that exact same asset back within 30 days, the IRS completely disallows your tax deduction. The loss is effectively washed away like it never happened. And you know, this creates such a dangerous illusion. On one side, you have the fantasy. Sell your stock or crypto at a loss today, secure your tax deduction, and just buy it right back next week when the price is right. Feels like a total win-win. But the reality? It's much harsher. Because you bought it back way too soon, the IRS completely ignores your loss. So they keep your taxable income high and trigger a taxable event without giving you any of the benefits. Let's move to Section 3, the 30-day math. This is how you avoid the trap. Let's break down exactly how the mechanics of this rule work against you step by step. Step 1, you sell your stock or crypto at a loss, thinking you're being super strategic. Step 2, you buy it back within that critical 30-day window. And Step 3, bam, you get hit with the dreaded, highly expensive empty box error on your 1099-B tax form. That empty box is the visible proof that you just stepped right on that invisible wire. Now, check this out, because the landscape for these assets has shifted dramatically. Stocks? Yeah, they've always been subject to the wash sale rule. But prior to 2026, crypto investors enjoyed this massive loophole where the rules simply didn't apply to them. Well, the party's over. That loophole is slammed shut. In the 2026 landscape, crypto investors are walking through the exact same minefield as traditional stock investors. The rules have tightened straight across the board. Alright, finally, Section 4, your financial fortress and how to protect your money. Now that we actually know where the invisible wires are located, how do we stay safe? Well, like CPA Brian advises, you absolutely do not want to let a simple timing error destroy your financial fortress. This is all about keeping your money in your own hands rather than handing it over to the IRS just because of a completely preventable administrative mistake. You've got to stay ahead of the curve so you aren't penalized for legitimate losses. So what's the ultimate solution? It honestly all boils down to this single, absolutely critical number, 31. The survival blueprint is incredibly simple, but it requires total discipline. You must trust the math and wait exactly 31 days, not 29, not 30. 31 days before buying your crypto or stock back. Doing that puts you safely outside the IRS's 30-day window, ensuring your tax loss deduction is perfectly valid, legal, and secure. As we wrap up this explainer, I want to leave you with something to really chew on. Is your 2026 tax strategy built on hope, or is it a real impenetrable fortress? Are you meticulously tracking that 31-day window every single time you harvest a loss? Or are you about to step on an invisible wire and get hit with that empty box on your 1099-B? Do not let a tiny timing error cost you your hard-earned tax savings. Thanks so much for joining me as we navigated this incredibly complex topic together.